Today we're going to talk about investment, urban living real estate assets. What are they worth and what are the opportunities post COVID-19? This session is the latest in a series of webinars in the run-up to an event called the Urban Living Festival, which we are very excited about. Now, it was planned for November 25th and 26th in London this year. If you haven't seen, there was a government announcement yesterday about further restrictions, which has created some doubts about this. So we're seeking clarification about what can and can't go ahead. We'll be making an announcement shortly. One thing's for sure, the event will go ahead at some point. It may not be in November, but it will go ahead because we know from our conversations with people that there's a huge appetite to get back out there and do business face to face, to meet our industry peers and to do some networking. So more news on that to follow shortly. Just a little bit of housekeeping, as I mentioned, if you could keep yourself muted, that would be great. We're going to have a 40 to 45-minute discussion with our panelists. If you have any questions arising during the session, please submit them using the chat function in Zoom, and we'll get around to those at the end and we'll try and answer as many of those as we can. My name's Ciel. I'm Editor-in-Chief of International Hospitality Media. We are an online B2B publisher of websites for the hospitality sector, and we are also a conference and event producer. I've got a fantastic panel of investors joining me today. I'm going to ask them to introduce themselves shortly, but first I just wanted to give a bit of context and background to the discussion today. So while the world is in a state of turmoil, there's an awful lot of uncertainty around, a lot of businesses are struggling, but there is a lot of investment going on. Brookfield have raised a record 23 billion during Q2 of this year. Their CEO, Bruce Flatt, said, while we don't expect a full recovery of the global economy until well into 2021, we believe the worst is over and our own businesses are slowly recovering. We've been keeping our powder dry, waiting for opportunities we believe will come. Hotel transaction data from Cushman & Wakefield shows that in the first half of this year, 5.7 billion euros were spent on hotel acquisitions. So it's a pretty chunky sum, and there are some other big deals that have been going on. The next few bullets I'll show you are all from the last couple of months. So AXA IM has completed the acquisition of Dolphin Square in London. The Portfolio Club, which is a JV between APG and London Central Portfolio, has bought a site in Central London for 76 million, which has got planning for a boutique hotel. APG and Aware Super have committed to fund an Amsterdam apart hotel operator, City ID, to the tune of 500 million euros over the next 4 years. Nuveen has funded a student accommodation project in Copenhagen to the tune of 100 million euros. And Indian co-living startup Zolo Stays raised 56 million US in Series C funding, mainly from existing investors. So all these are from the last couple of months. So, you know, while we're in uncertain times, there are deals being done. The landscape is obviously changing daily. It's an unstable landscape, but there are plenty of opportunities out there. So before we talk about specific assets and sectors, I just would like to ask my panelists to introduce themselves quickly and tell us what they do. So I'm going to go from left to right as I can see you guys in my gallery at the top. So Vedrana, if you'd like to kick off, please.
Good morning, everyone. Vedrana Riley, CEO and founder of Ciel Capital. We're asset managers and owner developers, primarily focusing on the hospitality sectors, ranging from apart hotels to more traditional hotels. And we also look after a number of family offices more in the industrial and residential spaces.
Thanks, Vedrana. Patrick.
So my name's Patrick Brennan. I founded Fair Value Capital 7 years ago. We advise on debt and acquisition investments, primarily in the hospitality space. We've executed about between 400 and 500 million of transactions in the last 3 years. Again, the majority in boutique hospitality. Those kind of deals have been across Europe, from Mykonos, Venice, Ibiza. We advised on the Turkey deal in Shoreditch, etc., etc. So we're now working on currently opportunities in the hospitality space, actually primarily in the USA, which is a much more liquid, efficient market, obviously, than Europe, and is more likely to get back on its feet before Europe.
Thanks, Patrick. Love, over to you.
Hi, thanks, George. I'm from Invel Real Estate Partners. We are an opportunistic real estate private equity platform that partners with larger, mostly US-based credit and real estate private equity funds. We've put about $1 billion of equity, $3 billion of gross asset value to work in the past 7 years, mostly in Southern Europe, Italy, Greece, and Cyprus, where within that portfolio we own 8 hospitality assets in Greece and Cyprus. And then I also come from a business called Best Hospitality, which is my family's owner, operator, developer hotel business. We currently own about 500 rooms between the Northeast and Southern United States, and are building 3 hotels here in London, and have are actively acquiring NPLs and REO assets on the in the hospitality space in the US, and looking to do so here in the UK.
Great, thank you. And last but not least, Kevin.
Thank you so much. Thank you for having me. My name is Kevin Colket. I'm the founder and CEO of Global Hospitality Investment Group. After 15 years in hospitality, most recently with Starwood Capital, for 12 years in the US, Europe, and Asia, I decided to go off on my own with some of my peers and start our own hotel private equity company. The reality is, we say we're hospitality-driven real estate, and that definitely does and will include things like co-living and service departments. And at the end of the day, we focus on renting rooms, whether it's by the day, by the month, or by the year. And right now, we're focused mainly on distressed opportunities on the Europe and the US, although we are also selectively looking at stuff in Australia and Japan as well.
Thanks, Kevin. The LinkedIn profiles of all our speakers are in the chat if you would like to connect with them and carry on conversations after this session, so please do. Before we talk about specific asset classes, I'd like to ask you each what your best guess is to the timescales for recovery from the volatile situation that we're in. And Kevin, you're in China at the moment, so you've got an interesting perspective on this one. Perhaps you'd like to go first.
Sure. I mean, like I'm sure everyone on the phone and probably everyone in the business, we're all tracking hotel occupancies and hotel ADRs, not just in our own markets, but globally. I think the good news is the worst is behind us. A lot of hotels still are closed, and in Europe and Asia, I think generally the US is largely back open. I think Europe, is around 22% was the most closed, the most recent statistic. Hotels opened at 10, 20%, or at least the ones that stayed open. And depending on where we are in the world, occupancies are definitely starting to recover. I think China is probably in the lead, where obviously COVID started in China, but it seems for sure that China is doing the best, out of most large countries today. I just got out of quarantine 3 days ago, and it really is back to normal. People are at malls, they're in restaurants, indoors and outdoors. People aren't wearing masks generally. They still check you for temperature on the way in, so there is a lot of testing, but things definitely seem to be back to normal. The most recent number I saw for the second week of September was that RevPAR in China was only down 7%. So if we're going to use hotel metrics, that's pretty spectacular. I will say it's choppy. The week before, RevPAR was down 25%. Whether it's the US, Europe, or Asia, I think there's one theme, and that is this has really been a leisure-led recovery. And when a lot of that summer leisure goes away, I think we're really going to have to figure out where business sort of corporate demand and groups stand. And I don't think it's going to be that good. So I think we're definitely going to have some challenging times ahead of us, not as bad as they were at the height of it, but I think that we probably saw a little bit of a spike in a lot of markets that is not sustainable. But just going back to China is 7% down last week. I think if the rest of the world can get back down to 7%, even a half the time, people will feel pretty good about where we are.
Love, you mentioned that you've acquired properties in Southern Europe, and those markets presumably are leisure driven. So does Kevin's experience tally with yours?
So actually this year, as you can imagine, has been a pretty terrible year overall, because the early part of the season was definitely impaired. If we look between the two countries where we have assets, Greece and Cyprus, actually the August and September were actually really good, and we outperformed expectations, not back to the level of 2019. Obviously, prior to that, they were not so good. Cyprus, unfortunately, our main asset we own there is a TUI asset, and because of the COVID tests, actually TUI decided not to send guests to Cyprus because they required a pre-screened COVID test before flying. So that's been a very big challenge for the Cypriot market this year that we hope obviously will change going into the next season, or maybe even for the next couple of months, because Cyprus does have a very long season. The one very positive news that we have for this particular asset, Aphrodite Hills, is that we were able to, because of issues of COVID, secured 2 large European PGA events at the end of October and early November that will help us make up for the loss in the earlier part of this season. So, I think by, let's say, being an opportunistic operator, I think we've hopefully helped to, let's say, mitigate some of those earlier impacts. Another thing that I would add in terms of recovery timeline, looking back to the US, I think it's very important to differentiate between rate level and rate structure and location of the hotels within certain markets in order to predict the recovery timeline. Just to give you some examples, the very low rate stuff in my portfolio, which is a older full service Ramada and a Days Inn, July and August 2020 were actually better revenue wise than July and August 2019. So and these are located in Delaware, so very quick recovery for those kind of travelers who can't Zoom their job. I think, and you actually also saw a lot of domestic tourism fill in gaps there. And actually an extended stay, we have Staybridge Suites in the similar market. August 2020 was better than 2019. Where we continue to see very big underperformance is hotels that rely on a lot of internal business travel, as you can imagine. So we have an asset, a Cambria, we opened in July, which is a newer higher-end brand from Choice, or we opened, in January. That thing is, the whole play is it's next to a 1 million square foot office park in Texas where State Farm's headquarters is. Raytheon has a big building. That thing's been empty all year. So it's and until business travel picks up. So that, for me, internal business travel is probably the longest recovery timeline. Everything else I'm quite bullish on in the next, even as soon as 12 to 24 months.
Mm-hmm. Thanks. So Patrick, with assets in the UK and the US, what are the differences you're seeing in terms of anticipated recoveries there?
Well, there are a few anecdotes that I can point to, but I think back up what Love just said. We're seeing, first off, when it comes to business, we expect that to go through a period of quite gradual distress. As Love says, with regards to internal business travel in the US, and I guess the same thing applies to Europe, there's no real reason why corporates would approve corporate travel given the cost and potential liabilities. So until there's a vaccine, I don't see how those assets are going to recover at all. And the opportunity may be to pick up distressed 2, 3, 4 star, really not the 2-star because it's cheaper, but 3-star, 4-star business hotel assets, and try and reposition them perhaps to like co-living type facilities. On the leisure side, as Kevin said, this is a leisure-driven recovery, and what we're seeing, and it's going to be a phenomenon I think that will carry on for a couple of years, is that non-urban hotels are doing really well. People are looking to get out of town right now, not into town. You know, anecdotally, New York is half empty. We actually looked at and have been advising on a deal in New York, which is to buy a boutique hotel. It was a small one on the Lower East Side, and we position it for kind of medium-term rental, residential rental, and keep it in that kind of state for a couple of years until the travel business and tourism market was normalized, and then convert it back to a boutique hotel. The deals we're working on at the moment, as I mentioned, are actually the US. It just seems to be a more active market. And we're working on a deal in LA, which is to buy what has been renovated into a cool, limited service, younger generation focused boutique hotel. But that will take about 18 months to renovate. So it's kind of got an inbuilt COVID hedge against it. And we're also working on a refi of a portfolio that belongs to a company that has an out-of-town boutique hotel portfolio. And they have, one of the particular assets that we're working on has seen occupancy go up year on year by 25%, currently to 95% through July, August, and September, because people are just getting out of cities and looking for out-of-town destinations. So there's a theme at the moment that actually, you know, the whole title of this urban living. Actually, right now, the demographic is definitely moving away from urban living, but at the same time, that is going to create opportunities because there will be an increasing supply of distressed assets that are either hospitality related, very probably will be office related, because obviously occupancy in offices is dramatically down depending on each country, but certainly in the UK, I think it's something like 60% of people are still working from home. So that market is going to go through a distress cycle sometime in the next couple of years as well. So it kind of depends where you're looking, but those are some of the investment tickets that I can say, that I can point to. The final point I'll make is that we haven't really seen a lot of distress supply in Europe. What we have seen is operators throwing in the key or giving the keys back to the propcos. We've seen that happen with the Curtain, we've seen that happen with the Ace Hotel in Shoreditch, and there are other hotels that cater for that kind of cool business millennial traveller who just don't seem to be travelling at the moment, that are going to go through similar situations. But in those situations, it was the OpCo that kind of threw the key, not the PropCo. So that's like an interesting thing.
Yeah, thanks, Patrick. Vedrana, you've got service departments in your portfolio. Have you seen those recover quicker than other types of hospitality asset classes?
You make a very good point. I mean, basically, there are two things I'd like to add to what's already been said, and I do agree to a very large extent with everything that's been said so far. I would say that operators have been, at least the ones we're working with, whether it's an extended stay or more traditional, I would say more limited service hotels, have really been able to squeeze the costs. And I would say when we're talking about recovery, there's obviously the top line, turnover is exceptionally important, but there's also the bottom line. And I think where we've seen very, very positive results is where the operators have been able to squeeze that cost to basically still end up with a positive bottom line, even if obviously the occupancy and the ADRs were lower. So I would say that's certainly been something we've been working very hard on. And when it comes to extended stay in particular, I mean, a lot of the extended stay hotels we have visibility over haven't closed at all during the pandemic. They've managed to keep a lot of their base kind of corporate inverted commas business, whilst obviously benefiting from a lot of the leisure over the summer months. And I mean, to quote a couple of examples in the regions, some of the assets were well in excess of 70% to 80% occupancy during August, which we thought was actually very, very encouraging. And that's not in traditionally very strong performing cities. London, as you know, we have our stowaway, has suffered a lot more. We've seen occupancy rise to 50-ish, 60-ish%. But obviously, whilst you do have some corporate, there just isn't as much, and it's mainly contractor and construction worker led. So it depends on how much you want to drop your rates to attract those occupiers. And then obviously there's been a bit of leisure, but without the theaters and without all the fun things when it comes to London to do, it has obviously been a little bit more challenging to really fully benefit from the leisure segment. But the regions have certainly done very, very well, and in extended stay in particular.
I'd be interested to know how the current situation has changed all your relative investment strategies. Have you, let's start with you, Vedrana. Have you taken a more opportunistic view in view of the current situation? Are you looking to buy and sell assets that wouldn't perhaps have been on your radar 6 to 8 months ago?
I would say when it comes to selling, you would rather keep very close to your chest anything that you can afford not to sell. I think that's really, going back to obviously there's a lot of capital out there for hospitality, as we discussed earlier. However, most of the capital that's out there for hospitality at the moment is chasing distressed. So I think anyone who can afford to hold on to their hotel, should probably wait it out and ride the storm. When it comes to buying distressed hotels, then obviously, as you know, a lot of our investors are exactly the same, and they're obviously chasing either repositioning or distressed opportunities. I think when it comes to new builds, it's certainly a lot more challenging. So we had exchange contracts on a central London opportunity, which was subject to planning. And to be perfectly honest with you, we ended up getting cold feet, and our investors certainly ended up getting cold feet, not because we believe this long-term or even medium-term wouldn't have worked, but I think developing a hotel in today's market is just, from ground up, is just a little bit more challenging. If you do own the site already, and if you're ready to go, then 18 months down the line, I would agree that it's probably the wise thing to do, especially if you already own the site. But going out there and buying something new with obviously investors and things like that is certainly a little bit more challenging. So we certainly are still looking at opportunities, but I would say we're probably focusing, like everyone else, on more repositioning opportunities as opposed to ground up, unless it comes by way of a partnership, which, as you know, we have with the likes of Network Rail.
Yeah. Love, I read something on CNBC a couple of weeks back which said that I think it was around 35% of New York City hotels are delinquent on their borrowing at the moment. So there's going to be potentially a lot of distressed assets up for sale. Has this situation changed your investment strategy? Are you actively looking to acquire distressed inventory?
I mean, for sure, in general, we weren't acquiring anything in the US in the years prior to COVID. We were finishing out some prior developments we had and actually exiting assets in our portfolio, given where levels were in the US. Obviously, COVID has completely reversed that strategy, and we've expanded our team now to include a group of individuals we worked with in the last cycle to buy distressed assets. To focus on New York in particular, most investors we talk to, most institutional investors we talk to, are pretty scared of New York at the moment, especially downtown Manhattan, because of the severe underperformance. But we've seen some and already the challenging performance pre-COVID due to the impacts of Airbnb and supply. But now we've seen some really interesting trades occur that I think are starting to set a level. We're actively looking at a couple of opportunities in New York. You've seen an Embassy Suites trade to a group called Magna, actually backed by capital from over here. Non-union hotel, high 300s price per key, pretty good price. You're seeing these are 30 to 50% discounts from peak levels. And then you've seen the Royalton sell to MCR, Union Hotel, but I think it was below 250 a key. Again, for a Manhattan hotel. What's interesting is you're seeing these at pretty attractive levels. So personally, I think it's an opportunity for New York City. I think to get into a market that's obviously traditionally very high barriers to entry, you have to be careful and budget, I think a significant amount of working capital for a number of years, and look to use 2021 to do repositioning and capex, etc. So I think you have to make a very detailed business plan in doing so. But I think there's a good opportunity there, and we're also focusing much more on urban select service rather than the full service, given the impacts to F&B in Manhattan. But there's a number of things in the market. It is competitive, though. I would say, while you've seen these trades, there has been a lot of capital raised. So I think our strategy also includes partnering with funds to maybe not always focus on just getting control of the common equity, but perhaps providing pref equity or mezzanine to existing owners, to put ourselves at an attractive attachment point where maybe they don't want to sell at that attachment point, and can still get transactions done that way and make interesting returns that way. And hey, if there are problems in the business plan and you have to step in later, at least with a group like ourselves, we're capable of doing that if we have to step into a more active role. So that's how we've approached New York. But things are starting to move. There wasn't much. Now I think you're going to see many more trades over the coming months.
Kevin, I think the situation is similar in a lot of other cities too. So are you actively looking at deals that you probably wouldn't have considered 6 to 8 months ago?
Unconditionally. I mean, I think for us, our view is the U.S. had been overvalued for a while, or at least it was late cycle. I think in the U.S.'s defense, it did a very good job, or the buyers did a very good job of widening cap rates late stages of sort of 2018 and 19. I think Europe and Asia did not do as good of a job. I think there was so much capital chasing so few deals that the cap rates never really widened like they should. So I think, frankly, Europe and Asia probably have a little bit more to move than the US. But for us, we were always thinking the US would probably, the cycle would come to an end in 21, 22. And obviously it happened a lot faster. I don't think we nor anyone else thought this cycle would be anywhere near as bad as the GFC. And it turns out that it's, significantly worse than the GFC. So whenever there's distress, there's always opportunity. I think the thing that we like to say, though, is that unlike the GFC, where hotels weren't closed, hotels generally weren't losing money, hotels generally could cover debt service because the interest rates were so low, I think everyone's going to have to plow more capital, to Love's point, back in for working capital, not only on a debt service basis, but even on an operating basis in many instances. And every time we have a stop and start, we think we have a new travel bubble, and then the rules get changed. This could be 6, 12, 18, 24 months. And I think all that risk and all that cash flow, if your base is going up, has to be priced in. That being said, we ultimately think whether it's the US, Europe, or Asia, we do get back to prior values. And, we think that there is some good money to be made really for the experienced operators. I think that a lot of the more LP style capital that has moved into hotels, unless they have really good operating partners that know what they're doing and know how to stop and start and change the business plan and stay nimble, we don't believe right now is a good time for them to actually get in to the market.
Okay, and these potential distressed acquisitions, would you have a different view to the timescales of holding those? Would you look to get these back on their feet and then sell them on in a shorter time frame than other projects that you've been working on for longer?
Is that for me? So
Yeah,
sure, I'll take that. I think every deal is different. I think at the end of the day, you need to underwrite the downside on a deal and not just look at the upside. And that's in any market. In today's environment, I think you need to look at 20 different scenarios. And you need to look at all of them, and you need to understand what's the worst case scenario and what's the best case scenario, and choose the deals that have the best risk adjusted returns. To answer your question specifically is, I don't think one can assume that you're just going to buy something down 30% off of 19 values and flip it down 10% in 2 years. Because if we're still in this thing and we haven't recovered to break even in 2 years, well, I don't necessarily think that's going to be the case. So I think for us, and I would love to sort of, hear Love's sort of strategy a little bit more for New York, but I would say we do believe New York has good opportunities for the right investor especially in the select service space. For us, we're less concerned about new supply. We're less concerned about businesses moving away from New York City. We're concerned about one thing, and that is the unions and labor costs. And even if you are non-union, there's always the chance that you might actually have to go union. So clearly by going select service, you get to avoid all that. But for us at GHIG, we struggle to see a path to profitability and a stabilized yield in New York. It's just a different buy. I think you just need to have conviction on the price per pound and the discount to replacement cost, but it's harder to underwrite that path to profitability. So to really answer your question is, when we can look at assets and say, hey, we're going to be able to buy this at an 8 or a 9 or a 10% unlevered return on cost on 19 NOI, and we're going to get back there, and we have conviction we're going to get back there. We just don't know if it's 3, 4, or 5 years. The answer is you're still going to make a lot of money. You might not make a 30 IRR, but you'll still make a 15, 18 IRR, even if you don't get back there for 5 years, if you're stabilizing at an 18 or a 20% sort of levered cash on cash return. So I think in many instances, we need to be prepared to hold these longer than 2 to 3 years. I think our general base case is 5 years, but I would say more than ever, we're probably prepared to hold stuff 7, 8, 9, 10 years. And under those scenarios, you're not going to make 20 plus IRRs, but to hold something over 7 or 8 or 9 years and make even a 15 or a 16, given where interest rates are, we think that's great risk-adjusted returns, and those are the opportunities I think we're mainly focused on today.
Yeah, I would agree that you're not assuming, especially for urban assets, 3-year business plans. You're looking at 5-year business plans plus, and as Kevin said, you're going to even if it's a mid-teens IRR, it's a good multiple and a good basis. And with the union non-union thing, it's very interesting in New York because I've met investors who want to buy the union stuff for the exact reason you said, Kevin, is that the non-union could easily go union, and you're getting generally between 100 to 150 a key discount for buying the union versus the non-union. That was recently evidenced with these 2 trades I mentioned. On the other hand, you have other investors who've just had bad experiences with unions, especially in New York City, and will just not touch a union property as a result. So I guess it's horses for courses, I suppose.
I'm not sure whether New York or France is harder to do business, but definitely 2 of the hardest places in the world to make money in hotels for sure.
Yeah. And I think the timelines can be a little shorter, probably in non-urban. Maybe you're looking at a 4 or 5 year business plan. If you're looking at, select service non-urban hotels, but remember those are 20, 30 million per asset transactions. You'll need to do a lot more of them to create scale. But I think there's very interesting opportunity there in the US and in the UK and other places. But I'm seeing obviously the opportunities seem to be coming much quicker in the US. Banks seem to be taking, and special servicers taking action more quickly there. So I think the window is just opening for the US and Europe.
One of the words that's quite handy to keep in mind is a little bit of a fuzzy one to some people, but it's relevant across different contexts, and that word is density. COVID seems to be more prolific in areas of greater demographic density, and there is a probable discorrelation between asset values that are either low density themselves or in low density areas versus assets that are high density, so very compact, shared bathrooms, that kind of thing. So the areas that we're focusing on are, as I referenced with that deal in California that we're working on, where the out-of-town hotel is currently operating at 95% occupancy. Those are the kind of assets and deals that are COVID friendly. When it comes to things like urban living and boutique hospitality, having compact rooms, a lot of guests traveling in lifts, having clusters in co-living that are sharing quite a lot of amenities. Those are assets that are going to have problems, and also those assets that are based in areas where there is a very high demographic density. If you're in Madrid at the moment, the south of the city is in lockdown because it happens to be the kind of the poorer end of Madrid, but it also happens to be where there is a lot of high density living. And if you own a hotel in that zone, you're in lockdown. So there is some COVID particular reference points that you have to keep in mind when you're looking at investing. The one I mentioned before, and I'm in agreement with everyone else, but the one I mentioned before is business travel. It's just difficult to see why there's any reason to recover anytime soon. Obviously, face-to-face meetings are important, but in the context of being able to use Zoom as an alternative, it just doesn't seem to make any sense for corporates to approve significant travel at the moment.
Thanks, Patrick. Let's move away from hotels for a minute. You mentioned co-living there. Obviously, it does have its issues in the present situation, but there has been a lot of investment into it, and a lot of people are looking at it quite seriously. So, are you guys looking at different asset classes such as co-living and student housing? Vedrana, let's start with you.
Sure. So we started looking at the multifamily markets probably before they were popular in the UK, and I think we're just a bit too ahead of the curve. I think the market has certainly matured a lot more now in the UK, for sure, in any event. And we've been working and helping a pension fund in particular that's developing a scheme in kind of North London, and exactly what you would expect. So small units, a lot of social breakout spaces and things like that. And I generally believe that there's a huge amount of demand for that product even today, regardless of COVID. There's a site we have, which is close to one of our hotels, where we've been exploring exactly the same use class versus what we would have normally looked at, which would have been another brand that complements the hotel we already have. And I think the institutional appetite is certainly there for the private rental sector. And from our standpoint, there's certainly demand for housing, certainly in the UK. There just isn't enough at the moment. I don't think the current economic and political situation is going to entice a lot of people to go out there and buy. And some of them, who would have normally perhaps been able to now start looking at acquiring something, may not be in a position to do so. And I think that having your own private space within a very social building, medium to long term, I mean, the human is a social animal, I think is one of the things that we shouldn't forget about. And I, for once, I mean, I'm certainly suffering from the Zoom calls because I really do miss the actual human interaction. And talking about business, there's no such thing as cutting a deal face to face, as opposed to just trying to do that, over Zoom calls. So I'm a huge believer that people are going to start traveling again and meeting face to face as soon as they can. Now, for my instance, I have had a few business lunches and I have had some physical meetings and things like that. And, I do, going back to the co-living side of things, I really do believe that there's still a very strong market there. And I suppose it's a market that's likely to benefit from possibly the lack of appetite for hotels from certain investors.
Thanks, Vedrana. Love, we've seen operators here in the UK, such as the Collective, become the first very recognisable brand, if you like, in that space, and they've secured significant investment through working with DTZ. Is that a sector that's on your radar?
So we have looked at the co-living. I mentioned I'm doing three developments here, and for one of the sites we have, and these were all started pre-COVID, but we've one of the sites we are considering putting a co-living scheme there, and I've spent a lot of time with a number of individuals at the Collective, actually, and I like I think it's a very interesting concept with long-term potential for sure. I think right now the sector is in a place where it's the first cycle, right, where this kind of concept has really been tested, and it's a very important time for that sector as a result, to see how the occupational levels between the shorter stay and the longer stay components of any of those assets play out, and it's a critical time in that way. And I think there are, therefore, because it hasn't been through a cycle, I think there are therefore going to be opportunities from an acquisition perspective around maybe sites that have been previously planned to build co-live, and maybe it's more difficult to fund, so therefore you might be able to buy them at an attractive basis and think about co-live or even changing the business plan for those potential for those sites. But I think that the thing I fear for the sector is just institutional funding and debt for that kind of sector in this uncertain time is going to be the challenge, because when you're lining up the average length of stay compared to a BTR or a PRS, and the expected exit yield for most of those developments having been more akin to PRS and BTR, it's going to be a tough one for a couple of years, is I guess the shorter way of what I've been saying. But I do believe in the long-term potential of the sector, given the cost of housing in urban areas. It's just going to be a lot of turbulence to work through, I would say, this cycle. On the BTR and side, I think, as we mentioned, there's been a wall of capital raised generally, and not all that capital has opportunistic risk appetite. And I see a lot of that capital going to BTR and PRS. And so it's a sector in my Best Hospitalities JV here we've been focusing on for a while and haven't been able to find the right sites. And I'm hopeful now the pricing aligns for forward fund structures to those funds who have raised large funds to own and operate BTR and PRS assets. And I think it's an interesting time to hopefully be able to buy those sites right in, say, zones 3 to 5, which have been difficult previously, and maybe some things can work out, and we're looking at a couple of opportunities there.
Thanks, Love. Kevin, in Asia, we've seen Ascot announce quite an ambitious rollout of its life co-living brand. Do you think seeing as big a name as Ascot putting its weight behind that concept, has that changed investment attitudes to co-living in that part of the world?
Listen, I think that I would agree with everything that's been said. Number one, I agree that people are going to stay social, especially younger people that haven't settled down with families yet, that are sort of post-college, and they're going to want to live with people, and they want good lifestyles. Number one. Number two, housing's too expensive. It's too expensive for every demographic, but especially for younger people. And if someone can get the perception of more amenities, more social space with a smaller individual space, which generally most, I think, co-living models follow, that's good value. And I think there's going to be good opportunity for that. That being said, the same things that I think have hindered the growth of co-living versus how we saw student housing explode out of, let's call it 2011, 2012, is we don't have the government support. We don't have the institutional backing. We don't have the super cheap debt, right? Or at least in most instances. And we don't have enough trades to say, hey, should this trade more like hotels, or should this trade more like BTR? And so for me, I think it's going to remain a challenge for a lot of institutional players who are trying to earn, the right returns to compensate themselves for the risk to build co-living in today's environment. When you can buy assets at a discount to replacement cost as a real estate investor, why build? Right now, if you're a builder and you can get cheap sites, especially some really good sites that would have never otherwise become available, and you're looking longer term, maybe there's going to be some opportunities. But I think in the short term, it's just going to be hard, whether it's US, Europe, or Asia, to justify new construction. I think the challenge with co-living, similar to the micro hotel sort of concepts, whether it's the hotels or the Citizen M's, is the best Citizen M's and hotels are purpose built, because that's where you get the efficiency. They make the most sense, in my humble opinion, when you're in high density, high land price, high occupancy markets, right? But when you don't have that going for you, and you don't necessarily want to go into the highest density places and you can't get construction loans, I think it's going to be hard to do those. So I think people are more and more going to have to look for conversions, and maybe things become cheap enough. Given where hotel occupancies are today, maybe hotels become cheap enough that you can give someone 450 square feet instead of 280 square feet. And is there going to be demand for that? Absolutely. So long-winded way of saying, I really like the long-term demand fundamentals of co-living. I think governments and other entities need to get more behind it. I think Ascot is going in the right direction. But if you're truly looking about, from a real estate investing standpoint, where's the best risk-adjusted returns in the world today, I would exponentially rather buy hotels and other forms of real estate at a discount to replacement cost and try to, fix the cash flow and hold them through the cycle than to buy a site and build. I don't see why anyone would do that today.
Okay, thanks, Kevin. Talking of conversions, it's likely that we're going to see, we're already seeing a lot of retail space being converted into other use. I've seen in the UK quite a few department stores being turned into hotels, apart hotels, things like that. And I guess that's a trend that's likely to continue. And there's also obviously a lot of uncertainty over the office market. I mean, if predictions for how many people will actually return to the office full time come true, they're either going to be sitting, with a whole lot of space around each desk, or there's going to be some excess inventory out there. Can you guys see the potential for converting excess office inventory to hospitality use? Patrick, would you like to kick off with that?
Sure. This is not an area of great specialization that I have, because, and I don't think many people do, except on an opportunistic basis. The reason being, offices have generally been very well occupied for the recent past. Today, because of COVID, we're seeing dramatic changes in office occupancy. And it's different across countries. In the UK, I mentioned earlier that 60% of people are still working from home, so office occupancy is around 40%. But that number is in the 70s, as in offices are occupied in the 70% in countries like France and Germany. So there's been a real different approach in different countries to how to adapt to COVID working environment. But without doubt, there is going to be opportunities. The major issues with offices is that the plumbing's different. They're not geared up to provide microservices across different locations around floor plate. But certainly we're looking at both derelict building, warehouse, retail, and office conversion opportunities at the moment. And I think, as everyone has said, the supply of living accommodation has always seems to be below the demand from demographics, particularly in urbanized environments. That's an argument I made earlier. However, right now we're seeing demographics move out of cities rather than into them. So there's all sorts of different currents affecting the market on the supply side at the moment, and distress is going to be one of the key words there. On the demand side, we're seeing a real obvious move out of cities. I guess it may be more related to the middle and upper classes who've got money to do that, but it's providing a noticeable demographic change. So you have to weigh up all these things, and probably the best advice is, if you go in cheap enough, and I think this is a little bit similar to what Kevin was saying, if you go in cheap enough, you can cover your downside risk best that way. So,
yeah, thanks. Love, please go ahead.
Yeah, look, we've spent some time on this over the years, but office is the problem. I don't think the pricing is ever going to work to convert it to resi or hotel, because in most cases it's going to be difficult to convert, as Patrick said, and you have to knock it down for the most part. Oftentimes conversions are more than new build. Retail is the right opportunity. I've spent a lot of time on conversion of large defunct retail sites into mixed use development or placemaking. You know, U Capital has done amazing stuff there with, not to be advertising for them or something, but I'm impressed with what they've done in Kensington Olympia, and now they've bought Shepherd's Bush. I've been looking at similar things. We were the cover bid on a 13-acre mall that traded during COVID, I thought would get pulled next to a station in North London. It seemed like a very full price from a retail perspective, but when you looked at the amount of resi and BTR units you could build on it, you were buying between 30 and 50K a door. So very, very cheap. Post-planning, that's easily 80K a door. So I think the area to focus on for, let's say, change of use to either rental, real estate led or mixed use is really larger, well-located retail site. Then you have a lot of, you know, B&Q or home stores also finding themselves in an interesting location for change of use. So it's definitely an interesting place, but as Kevin rightly mentioned earlier, financing this stuff is like super expensive and challenging right now. I don't know how you finance the build. So that's the problem.
Okay, thanks, Love. We've got our first question here from our viewers, and if you do have any questions, you've got about 5 minutes to get them in, so please do. So Mark Ayler is asking, hotel owners and brands were talking at length about conversion to white labels managed by TPO. However, the PIPs require capital and banks/equity are understandably hesitant to fund PIPs. Will this change in the medium term? Who'd like to have a go at that one? Kevin, I'm going to nominate you if nobody else wants to take it first.
Sure. So I think what you're asking is, you know, how prevalent are third-party operators going to be in Europe? And I'll even just add Asia, because I think at the end of the day, there's a lot less third-party operators in Europe and Asia than there are in the US. I think third-party operators make a better industry. I think they keep the brands honest from a management standpoint. I think they put pressure on them. I don't think they're the end all. At the end of the day, there's alignment issues with third-party operators as well. Especially today, a lot of the third-party operators in the US who have hundreds of hotels are trying to cut their workforces at the same time where they're being expected to do more. I think there's unconditionally opportunities to use a third-party operator, and they're just going to be more nimble, and they're just going to run a hotel more efficiently than the international brand. That being said, again, I don't think it's the answer to everything, because you ultimately end up paying the brands more. I mean, brands are moving towards franchises. They don't want to manage anymore, right? Unless it's, you know, one of their signature brands and they want to control the experience, or it's a big group house. Maybe under those scenarios, they can do a better job. But when you end up layering in the franchise fees and all the other fees, you're basically paying out, you're right out of the bat, you have to be able to save 3 to 4% of revenue just to break even. So then the question is, how much more efficiently can you do it? And then you factor in, you know, lenders, in terms of, are lenders going to be as comfortable with a third-party operator? I think the answer is yes, in the long term. I think they need to be educated. I think if there's going to be good third-party operators that meet the international brand standards, I think it's the flag and the brand standards that they actually care about the most. And to go to the PIP sort of question in particular, is there a greater PIP risk on a franchise? Is there, you know, than being able to force CapEx in a management agreement? Absolutely. That being said, I think at the end of the day, it can all be negotiated, it all can be underwritten, and I think the international brands need to be reasonable today. So I don't know if that necessarily answers your question, but what I would say is you are going to see more third-party operators. I think it's a good thing for the industry. It's not the answer to everything, but I definitely think it's going to make the brands more efficient. Everyone needs competition.
Thanks, Kevin. We're about to run out of time, but would anyone else like to quickly chip in on that one? Love, do you have any strong thoughts on Vedrana? Go for it.
Yeah, no, I'm a huge believer actually, and I would completely agree with what Kevin was saying, that third-party operators actually do keep the brands on their toes, and then you benefit at the same time from obviously the brand's distribution systems, but also all the efforts that the third-party managers in their relationships, you know, to try and fill your hotels. And frankly speaking, you know, again, looking at extended stays, some third-party operators do a better job than the brands.
Yeah, Yeah, okay.
And, yeah, in limited service in particular, for sure.
I would just add also that the brands so far, my experience is they're being helpful. All of my stuff in the US is owner operated under franchise agreement, and they understand the situation, are being helpful around CapEx, PIPs, even on fees. So I think everyone needs to just play well together and it'll be fine.
I would agree with that, Love. I think that so far, with the exception of the unions in certain jurisdictions, I think everyone realizes that we're in this thing together. And I think everyone is being, whether it's lenders, equity owners, or brands, I think everyone is generally trying to work together to solve this thing. So I would completely agree with you, Love.
Great. Thank you, guys. That was a fascinating conversation. Sadly, we're out of time. I'd just like to make you all aware of a couple of other webinar strands that we're running. My colleague Paul Stevens, who's the editor of Short Term Rentals, is running the Rock Stars series, which is speaking to leading figures in the short-term and vacation rental sector. And Eloise Hansen from Boutique Hotel News has a series called Boutique Hotel Trailblazers, and you can see the dates and the topics for the forthcoming webinars there. If you look in the chat function, you can see links to register for all our upcoming webinars. And as I mentioned earlier, this particular series has been a precursor to the Urban Living Festival, which was scheduled to take place on the 25th and 26th of November. Obviously, yesterday's government announcement has brought up some doubt about that. So we're seeking clarification about what can and can't go ahead in terms of events, and we'll be making an announcement shortly. We do know that people are really keen to get back to face-to-face meeting. We've got a great cast of exhibitors, sponsors and speakers already signed up for this event. It will happen, whether it will be in November or not, we're not sure yet, but it definitely will happen. And we really look forward to seeing lots and lots of you there. As you can see, we've got all these brands on board already. It's going to be a fantastic event. Here are the media partners. If you're interested in finding out more, then please get in touch with my colleague Katie. Her details are there and her LinkedIn profile is in the chat. I'd also urge you to sign up for the twice weekly newsletters from all our websites: Boutique Hotel News, Service Department News and Short Term Rentals. You can see the dates there of our next Urban Living webinar series. And just leaves me to say a big thank you to all our contributors, to Vedrana, to Love, to Kevin and to Patrick. And hopefully see you all on the next webinar, which is October the 14th. Thanks very much, guys.
Thank you.
Thanks, everyone.
Thanks, everyone.